of a sell-off. We're talking about index gainers and index stocks. Tata Motors is the one which is on our radar. Reported a solid set in the first quarter, driven by a big beat coming by in Jaguar Land Rover itself. Margins for the company have expanded and revenue surged by 57%. The important part, however, beyond the numbers, was the announcement of the conversion of DVR shares into ordinary shares. 10 Tata Motors DVR shares will fetch 7 shares of Tata Motors, as a result of which we are seeing a bigger move on Tata Motors DVR today. We have with us PB Balaji, who's the CFO of the company. Thanks a lot, Mr. Balaji, for joining in. Good afternoon. The JLR wholesale sales, that came up higher by almost 29% year on year. What's the outlook for JLR in terms of sales going forward and the full year?
See, the sales have been fundamentally a factor of supply starting to increase. Our order book remains strong. We started the quarter at 200,000 and ended the quarter at 185,000. And we did about 93,000 of wholesale this quarter. And going into next quarter, we do believe it will be similar. And thereafter, on a full year basis, we look at more like about 400,000 plus kind of units of sale. Which I think is the good part is most of these are what we call the MLA high products, the Range Rover, Range Rover Sport, Defender. So on this order book that is there, and hence pretty comfortable with respect to the kind of demand, the kind of mix that we are having, as well as the kind of revenues that we will be generating from that.
Okay, Mr. Balaji, JLR EBITDA margins, they came in at 8.6%, which was a 30-quarter high. It was led by higher wholesales versus retail sales and rich product mix as well. Will this continue? Will you reach the guidance of 10% margins before FY26 in this segment?
I think the 10% margin stands and we are quite confident of hitting it. I think as far as the current year is concerned, we have had well, that's 10% is FY26. The current year number is a 6% guidance on EBIT, which we have said we will review it if we need to revise it upwards at the end of Q2, because there's just one quarter that is gone. We'll wait for Q2 to complete and then we will share that. And don't forget, as far as Q2 is concerned, we have signaled that we do see some production shortfalls because of one is summer, and second, we're also expanding the capacity of our Solihull plant to increase the capacity by another 30%, which is where the Range Rover Sport and Defenders get made. So that's going to help us in the long run, but we have to take a pit stop to get that sorted. So some of this will impact Q2, but on a full year basis, we do believe the delivery will be strong, and we will review the numbers at the end of Q2.
Right, and the CV business, that reported a margin decline of just 70 basis points despite seasonality. Whereas Ashok Leyland, which is your peer, also spoke about good trends. What's happening here? Will you see better numbers in a better season?
See, two factors playing out here. One, from a demand perspective, we didn't get the full benefit of the operating leverage in this margin because you did see a decline in overall revenues compared to Q4. And over last year, the numbers did decline from volume perspective, and our revenue grew just about 4%. And that's because of the BS6 phase 2 migration that we had. And we did have a few issues on availability of stock because I think we did a pretty extensive change to our BS6 portfolio. And hence that required, we could have executed better compared to what we did. And those corrections are happening from June onwards, and by August we should be out of that. Once that is in place, I think with the strong demand environment that we see, we do expect to see volume starting to pick up and competitive growth starting to come back again, which should give us the operating levels that we are also looking for. With commodities in a moderating or a benign environment as far as CV is concerned, as well as our focus on quality growth, where we are looking at strong savings plan, tight control on fixed cost, as well as realization improvement, we do expect to see margins to improve. Therefore, the guidance for the year is a double-digit EBITDA margin, and we would want to meet it, if not beat it.
Okay, EV business also saw improvement in performance due to decline in lithium prices, likely starting of PLI benefits as well. What is the extent of these benefits and what is the growth expected? Will it be the growth driver for you?
See, for the current quarter, we did see a decline in the EV margins because we had two things here. One, we had IPL where we launched our Tiago.ev on IPL. So we did have a front ending of the FME investments, advertising investments. Second, we also saw significant runaway lithium prices last year, which is anniversarying in the current year. As we look forward, then we see multiple things coming in. One is the phasing of FME will mean that there is a better SME proposition going forward. Second, you would see a sharp reduction in lithium prices as we go forward, and we're tying up those battery cell contracts as we speak, and will be securing those benefits. Third one is the PLI benefit, where for Tiago, we already filed the ARAI certification with the government for securing the PLI benefit, and I would expect that to come through in the next 3 months or so. This is a substantial benefit because we would expect to see anywhere between 13% to 18% in terms of the exact number of in terms of EV revenues that will come back to us as PLI benefit, which should step change the profitability of the business. In anticipation of these benefits coming in, we already priced these products in the market as well as provided the right level of features in the market. Therefore, all of these will help us get to a strong margin profile as far as EV is concerned. Mentally, how we are working on this is that the only loss we should see in the EV business is related to product development costs that we'll be expensing to the P&L. Everything else should be priced or benefit secured, and that's how the model is being worked.